Hello everyone, and welcome back to our channel Time. Today, we're diving into a topic that could significantly impact your investment portfolio: silver. Andy Schectman has recently shared some eye-opening insights on why you might want to pay closer attention to your silver holdings. Let's break it down. Andy Schectman discusses the significant efforts by China and India to accumulate silver. China, in particular, is taking extensive measures to obscure the true extent of their silver production and stockpiling, focusing on acquiring unrefined silver to avoid affecting global prices. While many think in the short term, China plans with a long-term perspective, often spanning years or decades. The shift of China, one of the world's largest silver exporters, into becoming a net importer, despite already being the second-largest producer, signals the strategic importance of silver. Contrary to its perception as merely an industrial metal, silver is increasingly viewed as a strategic asset. Andy Schectman suggests that, while global attention has been fixated on the rising geopolitical tensions between China and the West, a more discrete, yet equally significant battle has been brewing in the financial markets. China has been quietly amassing large reserves of both gold and silver, signaling a potential shift in the global economic order. This accumulation highlights a growing need among developing nations for substantial resources to bolster their economic strategies beyond its gold stockpiling. China has also been ramping up its silver reserves. The Shanghai Metals Exchange has seen a notable uptick in silver trading, with prices frequently surpassing those on Western exchanges. This has led to speculation that China deliberately drives up silver prices to deplete Western resources. India, too, has emerged as a major player in this silver race, importing vast quantities from the West over the past few years. With India's recent decision to reduce its import duties on silver, the demand for the metal is expected to rise even further. Reports indicate that Chinese companies offer twice the Western price for unrefined silver ore and concentrates, especially in Latin American markets. This strategy allows China to refine the silver domestically, keeping it off global markets and preserving its strategic advantage. Similarly, India has accelerated its silver accumulation, mirroring China's approach as both nations tap into the reserves of key exchanges like the Lubma and Kongs. Experts such as Andy Schectman suggest that silver is now gaining recognition for its strategic value beyond industrial applications, as evidenced by these massive stockpiling efforts. This accumulate hints at a potential revaluation of silver shortly, as dwindling supplies and rising global demand could spark a dramatic price increase. After years of suppressed prices, silver may be on the brink of a significant resurgence, with China and India's actions potentially setting the stage for a historic price spike. One other point worth discussing is what the accumulation of gold by various countries means for silver. Here's something crucial to understand about silver. China, which is the world's second-largest silver producer, has traditionally been a net exporter. This is because silver is often a byproduct of mining other metals. In North America and elsewhere, mining companies produce only about 25 to 30% of the silver that enters the market. For years, China and its smelters had large silver reserves, exporting significant amounts. However, this year, China has shifted from being a net exporter to a net importer of silver. This change is driven by increased imports and a rebalancing of their domestic market, where they are now retaining more of the silver they previously exported. This shift is quite significant. China, the world's second-largest silver producer, has now become a net importer rather than a net exporter. Recent interviews with mining executives reveal that China is actively buying unrefined silver ore and concentrates from around the globe, particularly in Latin America, at double the price offered by Western markets. They then refine this silver domestically to avoid impacting global prices. Both China and India are aggressively accumulating silver. China is going to great lengths to conceal its production and accumulation of unrefined silver to keep it off the market and out of price visibility. This strategy highlights silver's strategic rather than just industrial value. China's long-term perspective contrasts sharply with the short-term thinking often seen elsewhere, suggesting a significant shift in silver's future value. The Global South is recognizing silver's strategic importance, which is contributing to the rapid depletion of silver reserves on exchanges like the LBMA. This has brought their levels to the second lowest in the 140-year history of the exchange. underscoring the growing significance of silver in global economic strategies. Andy Schectman says this is why they're draining the COMEX and why other exchanges are seeing delivery requests. We've been discussing this for years, and it's clear that the process has been both methodical and opaque. I believe this trend is accelerating. Silver will eventually have its moment. Everything we've anticipated about silver will come to fruition, but it will happen suddenly and dramatically. We'll likely see silver reprice or surge to a new level once the exchanges are depleted and it becomes harder to accumulate. At that point, anyone holding silver will not sell it at the current Western prices, but will demand significantly higher prices. Countries like China, which are already selling silver for $4 more per ounce in Shanghai, might drive the price even higher. This scenario is similar to discussions about revaluing gold. For instance, Senator Lummis from Wyoming has proposed funding a strategic Bitcoin account, in part, by revaluing gold held by the federal. Whether the West or China does the revaluing, a premium like the $4 difference we see now is just the beginning. Silver remains one of the most undervalued and potentially lucrative assets on the planet, despite its counterintuitive price movements and volatility over the past few years. Andy Schectman explains that those who believe they're combating inflation are merely addressing its symptoms rather than its causes. He critiques Kamala Harris's platform, which proposes measures like $6,000 tax credits for families with a new child, $25,000 down payments for first-generation homebuyers, and $10,000 tax credits for first-time homebuyers. Schectman points out that with the U.S. already $35 trillion in debt and facing unfunded liabilities, funding these initiatives requires creating more money. This inflationary policy exacerbates the problem. Yet Harris and others blame grocery stores for price gouging instead of acknowledging that inflation stems from excessive currency creation and unsustainable fiscal policies. In this video, Andy Schectman explains that inflation is always caused by an increase in the money supply, which is a direct result of government policies. He points out that creating money at an alarming rate, like $100,000 every second or $1 trillion every 100 days, constitutes inflation. Rising prices aren't the cause of inflation, but rather a symptom of it. Schectman criticizes the Consumer Price Index, CPI, and the way it's presented by the Bureau of Labor Statistics, suggesting it misrepresents the true nature of inflation. He argues that the real issue lies in irresponsible fiscal and monetary policies by the Federal Reserve and the government, which create these economic distortions. This situation highlights how misinformed the public is, and it's clear that even figures like Kamala Harris are missing the mark. For instance, the cost for farmers to process, package, and deliver food has surged by 31% since she took office as vice president. Despite this, she's incorrectly blaming grocery stores for the price increases. I used to joke that grocery stores, which make an average of just 1.5% profit, might be the least profitable sector. The real issue lies in the rising costs of inputs like fuel, seeds, and fertilizers, many of which come from Russia. Blaming grocery stores and attempting to impose price caps is reminiscent of failed policies from the 1970s. Share your thoughts in the comment section below, and if you found this video helpful, please join our community by subscribing to our channel and turning on notifications with the bell icon. Thank you for being a part of our community.